Today we will learn about Dow theory and how to apply it on live charts. Yeah. So without wasting any time, let's get on to the charts. You can apply Dow theory on any asset. Currently, we are looking at Bitcoin, but I will show you some examples from other assets also. So first of all, let's understand the basic tenet of Dow theory. What is it? So Dow theory is says that an asset is in an uptrend if it is continuously making higher highs and higher lows like this, right? So this is an uptrend. Uh, if it is making lower highs and lower lows, then it is in a downtrend like this. Okay. Now these two type of moves, this is clear uptrend and this is clear downtrend. These two type of moves uh, come under one category, which is a trending phase, right? Then there is another category, uh, which is sideways phase, wherein there are no clear higher high, higher low, or lower high, lower lows. For example, like this, right? So this there is no clear higher high, higher low pattern or lower high, lower low pattern, which is why there is no trend at all in this. So this is sideways or consolidation phase. This is second category, right? So market or any asset moves either in category 1, which means trending manner, or it moves in a sideways or consolidation uh, phase, right? Now so this is the basic fundamental of Dow theory. Now how to apply it on uh, real charts, right? So let's look at Bitcoin, and we can apply the same concepts on any assets, be it Nifty, Bank Nifty, any Indian stocks, US stocks, commodities, forex, whatever asset you want to trade, you can apply these concepts and you can trade accordingly, right? Now let me zoom out a bit. uh, let's study this trending move first and understand how we can apply Dow theory. So here what you should do is you should connect all the swings that you see, and you need not to be accurate in connecting these swings, right? You just need an idea basically, in which kind of phase the asset is. For example, I'm just drawing it roughly like this. You can draw it, you can connect swings um, the way you see them. I'm connecting it like this. For example, this is just a basic idea. Okay. Now once you've drawn all connected the swings, right, you hide the chart, and this is what you see after that, right? Now you need to see, now first of all you have to assess in which category this move comes. For example, this is a trending move, right? Because this is making clear higher high and higher low structure, right? So what we do is we start from the bottom. This is the low, right? Now, and this is the high. Okay. Now next low is above the previous low. Now next high, in order to be clear that uptrend has resumed, this high needs to be broken. the moment this high um, gets broken, you take a long position and you keep your stop loss below this uh, previous low, right? Because Dow theory suggests that if it is an uptrend, then this low will not get broken. Okay. However, when we are taking a long position here, we we don't know whether this is a crystal clear uptrend or this low will get broken, because if this low gets broken, then this structure which we were considering higher high high low, uh, then this is not a higher high high low structure. So this will not be uh, categorized under a trending phase. Okay. So we take a long position here and this low needs to be protected. Now next low was above the prior low and next high was above the previous high, and the structure was bullish because it was constantly making higher high higher low up till this point. However, after this it broke this low, right? This low got broken. Now this is the first sign that the structure may get changed here. However, it is not necessary that the structure will get changed. In order to get the confirmation, you need lower high, lower low. So this high, first of all, should be protected. Secondly, the next low should be below this low. Once this low gets broken and the high uh, is below this high, then the structure, we will get the confirmation that the structure has changed, right? And we will exit our long position which we entered here. But what happened after this low? There was this high which was below this high. Now if the next low, this low gets broken, then the structure will change. But here in this case, this low was not broken and the next high was above the previous high, and the structure, so we will say that the structure is not changed even here, right? But the structure got changed here, right? Why? Because this high was below this high, right? And this low was below this low. So once this high was below this high, we need to see that this low, once this low gets broken, we will get the confirmation that the structure is changed, and we will close our long position which we created here. So on here we will close our long position. Now we unhide the chart and see the price action. Now we see the move. We somewhere on 1st of October 2023 we took the long position and we exited it somewhere on 13 April 2024. So this entire move was somewhat 120% or roughly, right? So this is how you can apply Dow theory on real time charts. All right. Now second thing that you need to understand is, let me just remove these drawings first. Now let me give you another concept which is as important as Dow theory itself. Market moves in waves, right? For example, market moves like this. If it is in a clear uptrend, it will move like this. All right. So these are waves, right? And there will be waves within waves. For example, this is one wave. So in this case also, market will move like this. And so on and so forth, right? Here market will, in this wave, market will make lower high, lower low. Or it can go like this also. Right? But the trend will be downward of the waves, internal waves we call this. So for example, if we are currently analyzing this big waves, sorry, these big waves, then all these minor waves we call them internal waves. Okay, internal wave of this larger wave, these are internal wave of these larger waves. So just remember this concept. Now here, when we for example, here in this case, this was one large wave, right? And in this large wave, these were internal waves which we drew like this, right? So if you want to um, if you want to trade this big wave, right, you have to catch the trend in internal waves, right? So for example, when we caught the move here, we got long here, we were actually taking position in this, we wanted to ride this entire wave. All right, now uh, for example, in this, these are internal waves, and these will be smaller in proportion to this entire wave. So the lows will also be the highs and lows will also be smaller in proportion to this. Now here, for example, this was one wave, then there was this down wave, then there is another up wave, right, and so on and so forth, and there will be internal waves. So you trade internal waves keeping in mind in which phase the market is on a larger structure. For example, when we took long here, we were keeping in mind that the market is entering in a larger uptrend like this one, and we wanted to trade this entire move, right? Similarly, if we go short here, we will keep in mind that we are trading this entire wave, right? Why? Because waves will always form in proportion. For example, the uh, correction of this entire wave will not be like this, will not be this small, you know. It will be, because this is not proportionate to this is very large, all right, but this is very small in comparison to this. So this, if you are thinking that okay, here the correction is over and this high will get broken and I will go long, chances are very high that you will go wrong in your analysis. Why? Because this correction is not proportionate to this move. Okay, the waves will always be proportionate to each other in terms of degree. For example, this is a wave of larger degree, the correction will also be proportionate to this larger degree, which is why this move did not the correction did not get over here, because the wave was very long. So but here this is very much in proportion to the previous wave, this correction. So you have to keep this in mind if you really want to be sure that the view that you are the view that you are making in an asset is right. You have to have a very high probability in your assessment in order to become profitable, right? So as a trader, you shouldn't go long here. uh, you shouldn't go long here. Reason, because the waves are not proportionate. So which is why I told you that you have to keep this concept always in mind, that the waves are always in proportion